Hey, welcome. Today, we're diving into a topic that honestly makes a lot of people a little nervous, the risks of investing in mutual funds. But I don't want you to think of this as a warning. Think of it more like a roadmap. Because understanding the risks is really the first step to navigating them with confidence. So, let's get right into it. So, does this question hit close to home? It's probably the number one fear that stops people from even starting to build wealth. That little voice in your head worrying about your hard-earned money just, poof, disappearing. But what if I told you that understanding the risks was actually the secret to controlling them? Okay, so how do we start taking back control? Well, first, we gotta know exactly what we're up against. We're gonna break down the four major risks you'll likely face. Think of it like scouting the other team before the big game. You gotta know their plays. First up, we've got market risk. And this is the big one. This is the risk that the entire market, think of the Sensex or the Nifty, takes a nosedive because of big picture stuff, like economic news, global events, or yeah, even a pandemic. It's not about one specific company doing poorly. It's more like the tide going out and taking all the boats down with it. And listen, this isn't just some abstract theory. Let's make it real. You remember early 2020, right, when the COVID crash happened? A whole lot of equity mutual funds dropped by around 30%. That right there is market risk in action. It's sudden, and it affects pretty much everyone. But, and this is really the key, we also know that the market came back. So the point isn't to be terrified of the crash, but to know it's a thing that can happen. All right, let's move on to the next one, credit risk. Now, this is a big deal specifically for debt mutual funds. When you invest in a debt fund, you're basically acting like a bank, lending your money to companies or even governments. Credit risk is simply the chance that those borrowers can't pay you back. In other words, they default on their loan to you. And if you want a real-world example, we only have to look back to the Franklin Templeton crisis in 2020. That was a massive wake-up call for a lot of people. Several of their funds had lent money to companies that were struggling, and all of a sudden, they had to freeze withdrawals. It was just a classic textbook case of credit risk becoming very, very real for investors. Next on our list is interest rate risk. Now, this one can feel a little backwards at first. Put simply, when interest rates in the economy go up, the value of all the older bonds out there with lower rates actually goes down. And you might ask why? Well, it's because new bonds are now being sold with a much more attractive, higher interest rate, which makes those old ones look a lot less appealing. We actually saw this play out very recently. Back in 2022, the Reserve Bank of India started hiking interest rates to fight inflation. And what happens? A lot of debt funds, especially the ones holding long-term bonds, actually lost money. It was a really stark reminder that even so-called safe investments have their own unique set of risks. And finally, we have liquidity risk. You can think of this as the I need my money now, but I can't get it problem. It's the risk that you won't be able to sell your mutual fund units quickly when you want to, or you'd have to sell them at a huge discount just to find a buyout. You're most likely to bump into this with certain types of funds. For example, closed-ended funds are specifically designed with a lock-in period, and some funds that invest in things that are just hard to sell in a hurry, like real estate, might also have rules that restrict when you can actually pull your money out. Okay, so those are the four main risks. And I know, seeing them all laid out like that might feel a little intense. But here's where we pivot. The real difference between an anxious investor and a confident one isn't avoiding risk, because that's impossible, it's managing it. See, if you leave these risks unmanaged, they just lead to anxiety and potential losses. But with a solid plan, they're just part of the journey to hitting your goals. And that brings us to the best part of this whole explainer. Now that we've identified the challenges, let's talk about the solutions. This is your 5-point plan for taking control and investing with your head, not your fears. This right here is our toolkit. We're going to walk through 5 really powerful strategies: diversification, systematic investing, asset allocation, focusing on quality, and goal-based investing. Let's break down exactly how to use each one. First up, diversification. You've heard it a million times, but it's the oldest rule in the book for a reason. Don't put all your eggs in one basket. Just imagine for a second, you invested a ton of money in IT funds right before the tech sector had a downturn. Ouch, right? But if you also held funds in a totally different sector, say pharmaceuticals, any gains over there could help cushion the blow from your IT investments. Strategy number 2, using a systematic investment plan, or SIP. Honestly, you should think of this as your best weapon against the temptation to time the market. Picture 2 investors back in early 2020. One person throws in a huge lump sum right at the peak, just before the crash, and immediately sees a 30% loss. Yikes. But the SIP investor, They just kept putting in their fixed amount every month, which means they were buying more units when prices were low. This averages out their cost and helps them recover so much faster. All right, now let's kind of zoom out to strategy 3, asset allocation. This is really just diversification on a bigger scale. It's all about owning different types of investments, like stocks, bonds, and gold, that all behave differently depending on what the market's doing. Take 2022, for example. It was a really volatile year, and stocks were all over the place. But having an allocation to gold would have provided some much-needed stability, because gold doesn't always move in the same direction as the stock market. This leads us right into managing credit risk through quality selection. When you're looking at debt funds, it is so easy to get tempted by the ones offering the highest returns. But you have to remember, those high returns usually come from lending to riskier companies. A much smarter approach, especially for the core of your portfolio, is to prioritize high-quality funds that stick to top-rated, AAA corporate bonds or government-backed bonds. Here, the goal isn't chasing every last percentage point of return. It's making sure you preserve your capital. And our final strategy really ties everything together. Match your investment to your goals timeline. This is so important. Let's say you're saving for a big vacation in 2 years. Putting that money into a volatile equity fund is a huge gamble. I mean, the market could crash right when you need to book the tickets. For short-term goals, you need stability. And that's where low-risk debt or liquid funds are the absolute perfect fit. So, we've gone through the risks and we've walked through the strategies to manage them. And this brings us to what might be the most important takeaway of all: developing the mindset of a smart investor. It's really about shifting your entire perspective from fear to strategy. And this is it. This is the core idea I want you to walk away with. Successful investing isn't about finding some magical risk-free investment. Spoiler alert, it doesn't exist. The real goal is to understand the risks you're taking, to choose which ones you're actually comfortable with, and then to use the strategies we just talked about to manage them. That is how you invest with true confidence. So, you have the toolkit now, you know the risks, and you've got 5 powerful strategies to handle them. The only question left is, what are you going to build with it? Think about that first goal. Is it a down payment, retirement, your kids' education? What's the first smart plan that you're going to put into place? Thanks for joining me.